Hey everyone, ChargePoint stock is down 97% off the high. So is this an incredible buying opportunity for investors trying to capitalize on the rising growth of electric vehicles worldwide? Eventually, all cars are going to be electric vehicles, or are they? That's going to be an interesting point here. So let's take a look at what's been happening at ChargePoint and answer that question if this huge drop in stock price, this crash in stock price, is a buying opportunity.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Right, ChargePoint, I mentioned the stock price is down 97% off the highs, and I think justifiably so. If we look at its total revenue in the latest quarter, it dropped to 115.8 million from 152.8 million in the same quarter the prior year. And this is for the quarter that ended on January 31st, 2024. So revenue is declining, it's not growing. On top of that, the losses are rising. Its loss from operations, you can see here, 92.9 million, up from 78.3 million in the prior year's same quarter. So even though it had fewer revenue, fewer sales, the loss from operations still increased as it wasn't able to decrease the cost as much as revenue decreased, and losses mounted even higher. For the full year, losses increased to 449.9 million, up from 341.7 million in the same year, in the same time the year before, I should say. So mounting losses on the bottom line. Growth has vanished. It's turned around. It's going negative now as the company is realizing demand for its products are not as strong as it thought, right? It initially thought, well, all the cars are going to be electric vehicles. Electric vehicles need charging stations. We are going to be that charging station that everyone goes to, or a lot of people go to, and we're going to benefit and we're going to thrive as a result. I don't think that's going to be the case. I don't think that's going to be the case. And unfortunately for investors, they are the ones paying the price. The company continues issuing new shares, and investors now have been significantly diluted. The same quarter last year, they had 342.8 million shares outstanding. They now have 419 million shares outstanding. So they issued roughly 80 million shares. That's how they get the money to lose through their operations. Now, to make matters worse, they've got an inventory problem. Let me share that with you. So you can see here I've highlighted inventories ending January 31st, jumped to 198.58 million, up from 68.7 million in the same quarter the prior year. And this is even after the company took an inventory write-down, admitting that the inventories that it had, it wasn't going to be able to sell at the prices that it thought it would. So it needed to write down the inventory. That's the amount after the write-downs. And I wouldn't be surprised if there's more write-downs coming for this inventory, because they're not likely to sell this inventory at these prices that they have listed on their balance sheet. Now that's speculation on my part, but my reasoning is inventories would not have risen to this level if they had a market to sell to. This inventory jump being as large as it is at a time when the company is strapped for cash is really a bad sign. Usually when companies like ChargePoint are strapped for cash, they'll make deals for their inventory at 10% below usual, maybe even 15, 20, 25% below usual, just so they can get that inventory off the balance sheet and they can bring cash in. The fact that inventory remained on the balance sheet despite its cash flow difficulty is a sign that these inventories are becoming unwanted or stale or old. And charging station technology is improving quickly, changing quickly, and ChargePoint, let's be honest, doesn't have the most reliable charging stations. Tesla is, of course, the best at that. And so it's having a hard time selling this inventory, especially at a time when EV sales overall are not doing so well. The rate of growth has slowed, and its end markets are looking to this area as an unnecessary expense that they're trying to avoid. Why place these charging stations when we're not going to generate sufficient revenue from these charging stations to substantiate the price paid for these stations. So they're delaying it, they're pausing, they're pushing out, they're saying we'll do this later when EVs are more highly sought after, or after, there's already so much government incentives for, charging and electric vehicles overall. And it could be that it's not even enough. There might need to be many, many more stimulus packages passed to support this electric vehicle industry. If the US government really wants to push this on its citizens, it might need to accelerate these investments, because what they've done so far is not enough. More than 9 out of 10 people are choosing internal combustion engine vehicles, and only 1 out of 10 people are choosing EVs, even with the thousands and thousands of dollars of incentives in the market. Imagine what demand would be like, organic demand would be like, without those incentives. So, not an area that's looking good here for ChargePoint. Now, so far, the company has generated an accumulated deficit of $1.6 billion. Investors have given ChargePoint $1.957 billion in equity, right? This isn't counting any debt that they've gotten. And ChargePoint has proceeded to lose $1.614 billion through its operations, through building its business to where it is today. They've spent $1.614 billion. So, not very good progress, not the pace of progress I would like to see in any investment I'm considering. So, to make matters worse, the cash flow from operations in the 12 months that ended January 31st, negative $328.9 million. That was worse than the $247 million in 2023. So, their losses, their cash flow increasing, even though revenue is now decreasing. So, going in opposite directions. And of course, investors are the ones paying the bill. $287 million in proceeds from common stock sales. So they lose money during their operations, their course of business. They go to investors and they say, give us more money. They proceed to lose more money. Then they go back to investors and say, please give us more. And they continue in that cycle of losing money, going to investors, losing money. And it's not improving. That's what I dislike. I don't mind companies losing money to build a business or generating losses to build a business, so long as I see progress towards profitability, improvement at a reasonable rate. But I'm not seeing that with ChargePoint. Revenue $506 million, and you could see the operating income and the cash from operations going in the opposite direction, right? I like to see, even if they're losing money, stable or at least increasing those, or reducing those losses and reducing those cash outflows from operations. ChargePoint going in the opposite direction. It's selling at its cheapest valuation it has for a very long time, selling at a forward price to sales of 0.779. Used to sell at a forward price to sales of over 18. But as I've been repeating with these EV companies and EV stocks, they should have never grown to those valuations they did during the frenzy of 2020 and 2021, when everybody thought that, excluding myself, I never thought the EV industry was going to be as optimistic as many were forecasting. I always had doubts about the industry because of the fundamental reason that I feel like not enough people are paying attention to, and that is EVs are more expensive and they're less convenient. It takes too much time to charge and you're paying more money for the car. I don't understand that equation. It's not going to gain broad adoption with that kind of fundamental customer value proposition. It's just not a favorable customer value. Now, you're going to get some enthusiasts, some people that want to be early adopters, and you're going to make some early sales. That's to be expected. But getting widespread, broad adoption that some of these companies are built to do, ChargePoint cannot function at this scale. It needs to generate revenues at 3, 4, 5 times where it is arguably, maybe just 2 or 3 times. We'll see. But at its current level, you saw how much losses it's generating. So it needs the business to be a lot bigger in order to generate, at least be self-sustaining. It's not there, and it's not, I don't know when it will be, because revenue is going in the opposite direction. Now, management did say it expects to be, let me share that with you. It still expects by the fourth quarter of fiscal year 2025, ending January 31st, 2025, so in less than a year, it expects to have positive non-GAAP adjusted EBITDA. So that's a lot of adjustments there. EBITDA is already an adjusted number. That's earnings before interest, taxes, depreciation, and amortization. So you're taking out interest, you're taking out taxes, you're taking out depreciation, you're taking out amortization. You're making 4 adjustments, and then ChargePoint is going to adjust those adjustments. So you're heading at 5, 6 adjustments there. Even if it is able to achieve this, it's not like that means it's self-sustaining. It's still going to be generating most likely negative cash from operations. And they're still anticipating revenue to continue declining by 19% in the next quarter. So, I mean, if you couldn't already tell from my tone throughout this video, to answer the question, is ChargePoint stock a buy on this dip? No, I don't think it's a buy on the dip. In fact, I have ChargePoint rated as a sell, and I'm updating that recommendation today, April 22nd, 2024. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.